stock report on ONDS Holdings, that's ONDS.
And specifically that massive surge we saw, almost 30%.
Exactly, up to $8.72. It's all driven by the Centrix acquisition and a very, very ambitious 2026 revenue guidance.
So our goal is to give some high-level feedback to really strengthen the logic here.
Let's get right to it. The first point is about deconstructing that massive revenue target. So the entire thesis, it really hinges on one number, that $110 million revenue target for 2026.
It's the whole engine, right? It's what's supposed to reprice the stock from, a small IoT company into a real defense tech player.
Yeah, a powerhouse in CUAS, counter-unmanned aerial systems. And the report makes a compelling case that this is a, quote, pivotal milestone.
It is. But for it to really land with, say, institutional investors, you have to show them the math. You have to show them how it's actually possible.
And that's the weakness. The foundation is there, but I don't think the analysis quite grapples with the sheer scale of the challenge here.
Not at all. Think about it. We are talking about scaling to $110 million from a trailing 12-month revenue of what, about $24.75 million?
It's a huge jump.
It's a massive operational lift. You're talking about like 400% growth in a single year. And that's while they're in the middle of a major integration. Right now, the report just it broadly chalks it up to the Centrix acquisition and expanded Iron Drone deployments.
Which feels a little aspirational.
It does, because it's missing that granular nuts and bolts model that shows it's feasible, especially when you factor in, long defense procurement cycles.
Right, I agree. You can see the mountaintop, but the path to get there is, let's say it's pretty sketchy right now.
Yeah.
The analysis has great expertise on the CUAS market, that's clear, but it's the structural model that's missing. So the suggestion is to integrate some specific operational hypotheses.
You mean what's the actual ramp-up for Centrix?
Exactly. What's the time from a contract win to actual deployment? What are the staffing levels they need? What kind of contract win rates are we talking about? You have to illustrate the mechanism that drives the revenue.
Not just the shiny end result.
Not just the spectacular final number, yeah.
And that mechanism, it has to be segmented and, financially realistic. When you project $110 million, what's the profitability on that?
That's a great point. The margin profile.
Yeah, the material needs to spell out that mix. For example, is Centrix bringing in high-margin software as a service revenue? While the legacy business is, lower margin hardware? Because, $110 million of 80% margin revenue is a completely different story than $110 million at 30% margin.
A totally different company. That difference dictates everything about their path to profitability.
So how can they build that in?
Okay, so to give a concrete example for the revision, you could explicitly model that breakdown. You might say something like,
to reach the $110 million, we project Centrix has to secure X amount of revenue.
Right, which implies, say, Y number of large CUAS contract wins.
Each averaging Z million at a target gross margin over, say, 65%.
And then at the same time, the legacy IoT business has to grow at its own rate, maybe factoring in a bit of a slowdown from that insane 580% year-over-year growth we saw in Q3 2025.
But you still give it like a 40% margin floor.
Exactly. An approach like that shows a mastery of the financial engineering and the execution timeline. That's what gets serious investors on board.
It turns it from a goal into a credible plan.
And if you can prove the feasibility of that $110 million, then you can move to the next logical question, which is justifying the price.
Which brings us to the valuation.
Okay, so let's dig into the relative valuation argument. The report is correct that the market narrative is shifting here.
Definitely. ONDS is trying to graduate from being a speculative growth stock to a legitimate defense contractor.
And that shift is what pushes the stock into this massive forward price-to-sales ratio. We're talking about roughly 25 times based on that 2026 target.
And the bull case claims the stock is, quote, likely undervalued at current levels compared to peers like AeroVironment or Kratos, if they hit the target.
Right, if they hit the target.
And that's where I find the argument a little weak, as it stands.
How so?
Well, the comparison is necessary, but right now it's just conceptual. Why should ONDS, a company that's currently unprofitable and in the middle of a huge acquisition, why should it instantly get a 25x multiple? That's a premium valuation compared to established players like Kratos,
who have decades of history and proven profits.
Exactly. There's a risk here that by focusing only on the potential revenue, you're kind of glossing over the very real operational differences right now.
That's a critical point. The market is pricing in the dream, but you still have to justify the price today.
So the suggestion has to be to substantiate that premium.
Right. You need to build in a brief but explicit peer group comparison, one that actually tackles the differences in growth, in margins, in market cap.
You have to show your work.
You have to show your work and justify why the high expectations are, well, justified.
And what's great is that the raw data is already in the report. It's just hidden. You just have to connect those dots directly to the valuation.
Right.
The market needs to understand why ONDS deserves to trade at 25 times sales when the industry median is, way lower. You have to spell out that competitive delta.
So what are those non-negotiable data points you'd link together?
I think you need to define 3 key differentiators that earn that premium. For instance, you could frame it like this. While an established peer like X trades at 8x forward price to sales,
Okay.
ONDS's premium is justified by 3 things. First, its massive revenue acceleration. You point directly to that staggering 580% year-over-year growth in Q3 2025. That signals real traction.
Mm-hmm.
Second, its superior balance sheet. You anchor it with that, a $451 million cash war chest that de-risks the execution story.
Okay, that's a strong point.
And third, its pure play focus on the high-growth, high-margin $10.5 billion counter-UAS market that offers a growth profile that legacy peers, tied to older programs, just can't match.
I see. So that approach transforms a vague claim of being undervalued into a strong, evidence-backed argument for why it needs a premium.
It's the difference between just citing a comp and actually defending a valuation.
Okay, that's excellent. Now, let's pivot to the other side of the coin, which is equally important in any good report, the bear case.
All right, let's talk risk. This section is often where a good analysis becomes a great one.
By providing a counterargument that's just as robust as the bull case.
Exactly, and as it's written now, the bear case is, it's very concise. The company is still burning cash. If the new acquisition, Centrix, failed to integrate smoothly, the stock could retrace back to the $6 range.
The weakness there is just, it's a sheer lack of specificity, especially when you compare it to how detailed the bull case is.
Right, the bull case has the $451 million cash number, the $110 million target.
And the bear case just says burning cash. It's accurate, but it's not sharp. I mean, we know that heavy R&D and the Centrix integration led to a pretty substantial net loss, around negative $47 million TTM.
A critical variable.
And it's being presented way too generically right now.
Precisely. We need to translate that generic risk of integration failure into, required operational metrics or financial milestones they need to hit to de-risk the story.
So the bear case needs to answer the question, what specific event, financial or operational, actually triggers that fall back to the $6 range?
Yes, you have the negative $47 million net loss number. Use it. Use it to set specific risk boundaries and connect that burn rate to their capital efficiency.
That makes perfect sense. You have to tie the potential failure of the integration directly back to how they're using that huge cash runway.
Because that cash is their biggest buffer against execution risk.
So you need to give the reader specific things to watch for.
To strengthen this section, you use the data you already have to set some thresholds. First, detail the financial side of it.
Okay.
You could say, given the negative $47 million TTM net loss, their large cash position of about $451 million provides a runway of approximately, 9 to 10 quarters?
Right, at current burn rates.
Which gives them plenty of time.
Ample time to execute, yes. But that cash doesn't solve the strategic integration risks, so the bear case has to define those key non-financial risks for Centrix.
Like what?
Things like an inability to hire specialized engineers, or regulatory delays for their defense platforms, or even just resistance to tech adoption by big clients. And then you have to stipulate the financial results.
So you're saying we need to set specific, time-bound goals for stability?
Absolutely. The report should spell out the financial results ONDS must achieve. For example, maybe it's stabilizing operating expenses below a certain number, or hitting a target gross margin.
And you tie that to a specific date?
Yes, you say they need to hit these numbers by the March 2026 earnings report to prevent the stock from retesting that critical $6.70 support level. Wow, okay. That's incredibly actionable.
It gives the sophisticated reader a precise metric to monitor. They can track management's execution and capital allocation against a real timeline.
It turns a vague worry about acquisitions failing into a structured risk management roadmap. That's the level of depth you need for these kinds of high-growth stories. This has been a really high-impact critique. We're looking at an aggressive thesis on a very exciting stock move. So to summarize the 3 core actionable suggestions.
Go for it.
First, you have to validate the feasibility of that crucial $110 million revenue target. Do that by providing detailed operational segmenting. Show us the contract wins, the margin profile, the growth rates.
Second, you need to strengthen the justification for that high 25x forward price to sales multiple. Substantiate the premium. You do that by explicitly articulating that competitive delta, the growth rate, the cash runway, the market focus against its peers.
And finally, your bear case needs to be quantified and strategic. Give it detailed analysis of the integration risks and the cash burn, but set measurable, time-bound financial thresholds. What has to be met by that Q1 2026 earnings report to de-risk the stock?
And I'll just say, overall, the foundation of this report is exceptionally strong. I mean, that Q3 revenue acceleration of 580% and the $451 million in cash, that's excellent raw material.
It really is.
You address these 3 structural critiques, and this report goes from being a compelling story to a truly robust, market-leading analysis that fully justifies the stock's big move.
We really look forward to seeing the refined report. Once you've implemented these suggestions, send your work back in, and we will give it another deep dive. Until next time.